Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So here we are, March coming to an end, and not been a good month, not been a horrible month, but it's not been a good month. A lot of choppiness in the markets right now, and primarily due to the fact that there's a lot of uncertainty when it comes to our banking system. You know, as we all probably know, Silicon Valley Bank collapsed because it had a small number of depositors who had a lot of money on deposit at their bank, and they all decided, or at least most of them decided, to pull their money out all at one time, and within about 48 hours the bank went belly up. FDIC has stepped in, the government has stepped in, they're making all the depositors whole, but it's still pretty scary. And then in the following couple of weeks, we've had a couple of other instances where some major financial institutions look like they were in trouble, and so that's what I want to talk about today. It's what is the state of our banking system, and is our financial system on the verge of collapse? So I'm going to cut to the chase, and I'm going to answer the question right now, and that answer is no. So now I'm going to explain why. When you consider what makes a bank collapse, now let me be clear. When I say no, that we're not on the edge of collapse, that's unless all of us decide to pull all of our money out of the banks right now. Because it doesn't matter how good a bank is, it never keeps all of the depositors' money available in cash. It can't do that, right? How can a bank afford to pay you, 2, 3, 4% on your savings if they're not taking the money that you deposit and then putting it to work somehow, doing home loans? So imagine if they're going to pay you 3% on your deposit, they're going to go loan that money out right now at a little over 6%. So they're making 3% profit on your money. And so they're basically earning interest on your behalf. Now, sometimes they won't do a home loan. They'll just go buy a treasury. So maybe they can buy a treasury that pays them 4 and they're paying you 3. So again, there's positive arbitrage there. So they're making some money. It's all good. The problem is that when they take your deposit and they go do a home loan, well, they can't get that money back, right? Because they just entered into a contract with a borrower, and so the bank's now legally obligated to let that borrower pay that money back over time. So if we all go to the banks and say, "Give us our money back," our money back, the banks just physically can't give it to us. But realistically, that's not what we're all going to do. There are cases where people are saying, "Oh my gosh, I'm concerned. I'm taking my money out of the bank. I'm gonna go, buy gold or silver or stick it under a mattress or whatever." Right? There's lots of people doing things because they're concerned. And so now I'm going to just show you a couple of charts, but they're basically explaining one thing. So the first chart I'm going to show you just here real quick is here's the total amount of money that people have on deposit at banks right now. And it's about $18 trillion. So that's a lot of money, right, on deposit. But then there's this next chart that I want to show you, and that's of the money that's been deposited at the banks. And sometimes, banks get money not just from you and me as deposits. The banks will get money from the federal government, right? Quantitative easing, remember those words? Started during the financial crisis of 2008. The Federal Reserve started printing money and giving it to the banks. Well, there's so much money in the banking system, and they can't even find a place to put it, that what the banks have done over the last 15-ish years is they've started depositing money back at the Fed. So this chart that I'm showing you right now shows, since like 1959 until current, you see that the bottom of this chart is like next to zero. And that's how much money, excess money, the banks kept at the Fed in the history of, since 1959. But then all of a sudden around 2008, when quantitative easing started happening, the banks were just flush with cash, so they started depositing it back at the Fed, and the Fed has been paying them interest on those deposits. So here's why I don't believe that our banking system is having liquidity issues or is on the verge of collapse or is even likely to collapse. It's because look at all the money that the banks have readily available to them that's just sitting at the Fed. It's $3 trillion. I'm going to update this chart to bring it up to 2000 so that you can see sort of the magnitude of this. So there's $3 trillion. I mean, I can't emphasize that enough. $1 trillion that's just sitting at the Fed, owned by the banks. So if a large depositor at Wells Fargo, says I need, $20 million, Wells Fargo just goes to the Fed, takes $20 million out of its excess reserves, gives it to that guy, and off they go. No crisis at Wells Fargo. So there's a ton of money that's just sitting at the Fed that can backstop what's going on in the banking system right now. Now, Silicon Valley Bank was an exception, right? Because they didn't have a large, diverse number of depositors. They had a small number of depositors, relatively small, that had super high deposits. So just a handful of those people decide to leave, and they actually cause a financial crisis at the bank, because the bank's never going to have enough excess reserves sitting at the Fed to cover half of its depositors walking away. But almost none of the banks in the United States are like Silicon Valley Bank. And I think now that Congress and the SEC and the FDIC and the Treasury are sort of more keen to what's going on, more clued in to what's happening at places like Silicon Valley Bank, I expect to see some regulations coming down the pipe here, so to keep banks from putting themselves at that kind of monetary risk. And if they're going to have such a specialized specialized clientele, the Fed is likely going to require that they keep even larger deposits at the Fed, not in excess reserves, but in actual required reserves, so that they can handle these kinds of runs on the bank. So long story short, our banking system it's just not in trouble. I mean, the reality is that there's plenty of money in the banking system, that as long as all of us don't decide to just pick up our marbles and go home, then the banking system's going to be fine. The media keeps pushing the fear, and the stock market fluctuating, because bank stocks are up one day and they're down the next day, and they're just dragging the market all over the place. But that's not because of math, because if you just look at one chart, right, the only way banks get in trouble is if they lack liquidity, the ability to give money back to depositors. And if you look at the excess reserves, the banks are not short of liquidity to give to depositors, unless we all decide that we're going to get out of the banking system. So I'm not running out of the banking system, but if everybody else does, I would join them. But I don't think that we should, because why should we cause a problem that doesn't need to exist just because we're afraid of a problem that we can cause? It doesn't really make any sense. So in any case, in my view, my perspective, based upon the data that I've shown you, as long as we don't take all of our money out of the banks are fine. They're perfectly solvent. They earn more than they pay out, and that's a good business model. So don't let the media drive you into making really extreme decisions about what you should be doing with your financial future, because it's highly unlikely that we the people all decide that the banks are no longer the place that we want to keep money. Retirees right now are loving the fact that they can now actually go and get a 4% CD. I mean, they haven't been able to do that in 15 years. They've been having to deal with 0.5% CDs. So just one little anecdote. If you have somebody who's like, I retired 15 years ago and I figured I'd be able to earn $40,000 on my $1 million of cash that I have spread out across the banks, and because I can get 4% CDs, and instead of getting $40,000, interest rates went to nothing, and they've been getting $5,000. So $35,000 less. Their retirement has suffered $35,000 less earnings every year for 15 years, and now they're able to actually get that $40,000. So for a ton of retirees, what's going on with interest rates right now is a blessing. And so they're not running from the banks because they want that income. So don't cause the banks to fail on them, because they're going to fail on you too. Because again, we can cause the problem that we fear, but we don't have to. If anybody has any questions about this or any other financial matter, I'm here to answer any question you're willing to ask. So that was your update. I hope you enjoyed it. If you did, give me a like, give me a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching.
If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.